Hey everybody, it's Pete. Good morning. Welcome to today's stock trading lessons. And they're actually going to be feedback from comments that we got. So that the biggest thing I want to get across today is that if you have any questions at all about anything you might happen to watch in the videos, whether it's stocks for breakfast, whether it is our actual game plan of which stocks to pick, please absolutely feel free to leave a comment. And as soon as I can, I'll get back, I'll answer it. And hopefully if it's something that I think everybody could learn from, we'll do exactly what we're doing now, which is read back those comments and then provide a little bit more in-depth answer other than what I might have replied to. If you do find these videos helpful, it would mean the world to me. If you can click down and subscribe, that would be awesome. So first one we're going to talk about is a question from James Moulton. Thank you, James, for the question. Says, I'm just getting into this and I have some questions. I'm curious, how does your planning differ for between the open and the close Monday through Friday? And do you have the same procedure every day? Or since Saturday and Sunday give a lot of time for bad news, has your strategy changed in the last 6 weeks? First of all, absolutely the strategy hasn't changed. So let's make a distinction between strategy and tactical implementation of a strategy. My strategy has not changed. The strategy is always I am looking for the best trades that have the most obvious order flow. And order flow is smart money, the market itself, hedge funds, whatever, however you want to define smart money. Smart money means the market that pushes and moves the market around. It's supply and demand. So much more than just saying I'm looking at a trend, though. And that's a lot more detail than we can get into today. That maybe another video. And I'll actually post a link below, two links below this video today for you to take a look at. One's on order flow and one's on stocks to pick, which is a question I'm going to get to in a minute. So the tactical implementation of the strategy basically comes down to, because the market was in so much day-to-day chaos and there was just so much news coming out every single day, you couldn't look at the charts and say, well, I think that we're in a bearish trend right now. And I just want to be long or short. Now, and that was evidenced last week by the rally that we had where it was, I think, 3,000 points in the Dow in 2 days or something along those lines to the upside. So you couldn't just blanket say, I just want to be short every day. I'll be selling stock every day. For the most part, you could have, if you had considerations from the short-term order flow, which if you're watching the videos, we're generally calling that how price is trading above or below the opening price. And I have a really good example of that. And then where is it trading from yesterday's high to yesterday's low? And then to add even further than that, how many days in a row has the stock been well offered or well bid? If you're new to the video, well offered or well bid means higher highs and higher lows on the daily candlesticks as the most recent price action to validate order flow, because the smart money is creating higher highs and higher lows to have a stock well bid. I also got a question about where I came up with that from, and if there's another video that I talk about that. When I was first started trading back in 2000, you would say a stock was well bid reading a level 2 box, and there's actually a video of level 2 trading in here as well. I'll post a video, link to that at the end of the video, where Goldman Sachs was on the bid. You would say it was well bid because that quote of 5,000 shares meant a lot. So you would see people actively selling, and Goldman Sachs would basically just keep taking on the shares. So that meant you would tell each other in the room the stock was well bid, meaning that there's a real buyer there, what's known as a natural buyer in this case, who is buying stock on the bid and holding it there. So you felt comfortable buying at the offer in this case, expecting them to raise their bid and the price would go higher, and you would follow them up until it wasn't well bid anymore. So that's a question. But the tactical implementation of the strategy is that I was only looking for much shorter term calls. I was only looking for much shorter term ideas because it was a day-to-day situation where I normally don't only talk about day trading opportunities, but it seemed to be, in my experience, the right thing to do. Well, first of all, I have no idea how long anybody else is trading. I don't know if you're looking to hold the trade for an hour or 6 months. I have no idea. So I make it very clear in the videos that what I'm looking at in that situation is, and I'll say it clearly, I'm looking for hold to the close. I'm looking to hold till Friday. I'm looking to hold this as long as it's well bid. But in general, the game plan switched to much shorter term trades because the bigger picture is a mess. You're not going to look at a moving average and say, I think that it's going to hold the 20 period moving average while the market's just getting absolutely crushed. And then you get a short covering rally where it's quickly going in the other direction. So it was important to have short-term tape reading skills for that. The last part I want to touch on is the part of when I do the game planning, and it's not affected so much Friday afternoon to Monday morning any differently than Monday night through Thursday night looking for those trades. The easiest way for me to explain it is I do all of my game planning on the sevens, assuming nothing comes into the day and ruins it. But I do it 7 p.m. at night where I'm doing all of my scans, searching, looking at news to see if anything's going on in the regular stocks that I trade. So I'll look for my setups and I'll create a list of stocks at 7 p.m. at night. So it gives me a chance to unwind from the market, come back with fresh ideas, maybe go for a walk, have dinner and whatnot. And then 7 a.m., I just do a quick scan of the news to see if anything unusual came out on the stocks in my list that would affect whether I want to be a buyer or a short seller of those stocks the next day. So to keep that quick, 7 p.m. and 7 a.m. So I do it on the 7 p.m. to do my first run through, 7 a.m. to confirm that the trades are still good. So I hope that helped James Moulton. Next, we have a question from JM. From Greg. Especially for beginners, do you feel it's best to have a list of small symbols that you really learn how to trade, or scan the best bullish or bearish symbols based on the context of the market? The answer is yes to both of those, actually. When I first started trading, I was only trading one stock. That was all we were allowed to trade when we were proprietary traders back then. As a matter of fact, back then it was mostly 99% NASDAQ stocks, and I was only allowed to trade Cisco, which, if you know anything about the market back then, it was considered the main barometer of the NASDAQ back then, which obviously that was the internet boom, or actually the end of the internet boom. So it was a really big indicator stock, even more so than the actual indices itself. Cisco was such a large part of the market back then. So yes, if you're a new trader especially, and I want to make this clear, if you're a new trader in my definition is somebody who's not making money. I don't care if you're trading for 2 years, you're still a new trader if you haven't figured it out yet. If you're not on the other side where you're making money on a regular basis, in my opinion, you keep making the same mistakes or not learning, and I would consider you a new trader. The problem with that kind of a trader, though, is they've studied so hard, they hold on to what they've learned, and they're very hard to teach, believe it or not, because they want to stick to what they saw in books, but they're sticking to what's not working. So it can be a little challenging. So a smaller list of stocks that you feel comfortable with is easier to get to know the personalities of those stocks, the volume, the average true range, how much it moves. And here's a really kind of small thing that most people don't realize is, for example, let's say you're long a stock and you know how much it kind of pulls back on a regular basis. You won't get shaken out of good trades because you know how the stock normally trades. You'll know it's an unusual move versus a normal move. So yes, I would, if I was teaching somebody, or like when I had my firm and I was giving people my money to trade, I would actually recommend that you trade a smaller list of stocks. It could be 3, 5, 10 stocks, whatever it happens to be, and then you make a game plan for those stocks. And then the last part of that, trade bullish and bearish symbols based on the context of the market. That's a really deep question, Greg, because first and foremost, every single day you should be looking first to see what is the market doing. Is it obvious as long-term order flow and short-term momentum, so that I could now just only look for trades on the long side because all of that money's doing the same thing? Those are always the best trades. If that's not the case and the market's kind of just trading back and forth where there's indecision, maybe you got small bodied candlesticks, inside candlesticks, then you could just trade what your stock is doing for that day, but you would trade it with maybe a little less conviction, maybe a little less risk profile, because the big picture is not in sync with, or obvious, I should say. That shouldn't stop you from trading your stock. You could trade your stock all day, every day. If it's obvious, you should obviously trade it. You could just be a little bit more aggressive if and when the market is on the same side as well. Because we've seen plenty of times where your stock might go up 5% for the day, but the market didn't do anything. That shouldn't stop you from making money in that stock. But in general, in my experience over 20 years now, it's easier to learn a list of stocks and then expand that list to open up yourself up for more opportunity. I'll actually post a link here in the chart in the bottom of the video, and I'll just, it's called How to Find Stocks to Trade. It's a pretty short article, but it's really, really good. The last one I want to get into is a post from Jim Freedom is his name. That's what he posted. And he said, Pete, I didn't find I got anything out of this video other than yesterday was tough for you and probably everybody. First, Jim, thank you so much for the comment and the feedback. Look, the bottom line is it's very important for traders to learn that all market conditions are not the same. Quite simply, there are some market conditions that are better than others. So the title of the video was what to do when the market doesn't make sense. And what I'm trying to impart there is that it's your responsibility as a trader, and hopefully mine as somebody who might consider a mentor or somebody you can listen to from my experience. It's my job to hopefully walk you through those periods so that you recognize it next time, so that you keep money in your pocket, to recognize it's not the greatest situation in the world. Because learning how to not lose money is a huge part of learning how to trade, because as soon as you learn how to not lose money, you have more money available when the market's obvious, because it's really not that hard to make money when it's obvious, as everybody saw when the market was just going straight up for 2.5 years, right? Everybody was 401k millionaires. So Jim, it's a really good question, and maybe the context was missed a little bit. If I can help somebody understand when the market is tough and you pull back a little bit and this is the key, recognize it while it's happening, that will help you be a better trader instantly, because you're not going to have to make back that money. There's nothing worse than over trading or being too active when the market's not good. And I'll just throw a number out there, and you lose $1,000. Again, just throwing a number out there. And then the market finally picks a direction, and now instead of being flat, which means you didn't lose any money because you recognized it was tough, you now make $3,000 and you're up 3,000, as opposed to you're only up 2,000 because you didn't recognize the conditions were bad. So if you use the vernacular, the phrases that I use, building an argument is a part of that situation. So when you learn to build good arguments and the argument makes sense, and the risk justifies the profit potential because of this argument is awesome, you learn to trade and trade more confidently, and most likely will make more money, assuming you follow your plan flawlessly. By the same token, the opposite side of that is when the market's tough or it's not making sense and your arguments are really weak, you make a decision, or you learn to make a decision. I'm not going to risk as much, if anything, because this isn't making sense to me. And you have to be completely okay with that. So I was talking to one of the coaching clients, John, and we were talking about, well, I wanted to be short and stocks were rallying, so I wasn't doing anything because it didn't make sense to me. And yes, it might look once or twice that you would have made money just trading, regardless of what the bias was you had going into the day. In the long run, it's not the best thing to do, because what will happen is you'll say, well, right now it's going up, but I really want it to be selling coming into today. You buy, all of a sudden the selling peaks, and you're long and you're saying, no, it's going up today. And all of a sudden, all the sellers that created that selling environment over the last days, weeks, and months come back and hammer the stock. You take a small loss or a tiny profit on the way up in that little blip to the upside, instead of making a ton of money on the downside in the direction of your bias. So the 1 or 2 times that it works, it's not worth it, because the other 80 to 90% of the time that you should have been looking in the other direction is the real play. So again, Jim, thanks for that question. I love all feedback one way or the other, because look, it's the market's always changing. We can always get better together. And I guess that's kind of the whole point of the community. So hopefully these stock trading lessons help everybody. Thank you so much for the comments. If you like the videos, please subscribe. If you have any questions, absolutely leave a comment. I'll speak to you soon, everybody.